It's not just millennials or even Generation X that are buckling under the weight of student loan debt and the financial stress that comes with that. So are older Americans over the age of 60, believe it or not. As of 2022, there's approximately 3.5 Americans that are 60 and older that still have student loans, and combined, that's worth about $125 billion in outstanding student loan debt for those 60 and older. And today, baby boomers hold about 7% of student loan debt that's outstanding. But more surprisingly, as of 2015, 37% of those 65 and older that still had student loans were in default. Earlier this spring, there was much concern in the financial press on the potential garnishment of Social Security benefits, believe it or not, for those who are delinquent or actually in default of their federal student loans. And we have not had any collections really being taken place since the COVID-19 pandemic began in the spring of 2020. So here we are 5 years later. The Trump administration signaled, hey, we're going to resume collections, including those who have Social Security could see their benefits cut. So this is something of concern because in 2015, 37% of those 65 and older were in default on their student loan. And recent data from the CFPB shows that over 40,000 borrowers 65 and older were having their benefits garnished at that time due to their loans being in default status. Now, keep in mind, this is 2015 when they were still doing collection efforts actively for student loans. But then in the pandemic, of course, they stopped that. So we had a five-year pause, So as of last month, however, about 452,000 Americans 62 and older were in default of their loans. And you could argue that this is a silent retirement crisis. Now, this problem's been with us for quite some time in the last 2 decades. Between 2001 and 2019, the number of Social Security recipients, you notice 2019, before the pandemic. So the number of Social Security recipients who actually had garnishments from their Social Security for student loans rose from 6,200 in 2001 to 192,300 in 2019. So that's a 3,000% increase. Says those who have defaulted on their federal student loans will not be at risk of having their benefits garnished, said a Department of Education spokesperson. And they did begin collections for everyone else for those that are overdue on their student loans. And as I mentioned, over 452,000 people that are 62 and older have student loans in default. That is a shocking number. But they have not garnished any Social Security benefits since the COVID-19 pandemic. But not everyone agrees that this is the best approach, just simply pausing it. It says this collection tactic is woefully insufficient, said Persis Yu, an executive director of the Student Borrower Protection Agency. Any continued effort to restart the government's debt collection machine is cruel, unnecessary, and will further fan the flames of economic chaos for working families across the country. That's a debate that I've heard people have for a long time. If you take out a loan, you should be personally responsible for it. I know that during the Biden administration, many of these loans were forgiven, but this is going to be at least a pause for older individuals because that will give them some relief. But here's the disturbing part. While this is welcome news, the pause is still going to have a specter of future collections looming over older Americans' heads because what can be paused obviously can be resumed. Now, how could you as a reverse mortgage professional potentially reach out to this very specific group of at-risk seniors? There's a few places you may want to examine. One would be elder law attorneys because they're the ones who are frequently consulting with clients about their concerns about delinquency or other legal notices or who are facing financial hardships. And then also you have local senior centers and nonprofits that provide financial counseling and local student loan ombudsman offices. They may be able to refer clients who own their homes that are facing a potential collection if this is unpaused. So the good news is that they're not going to be garnishing Social Security benefits for the time being. But, what's going to happen in the next administration? Could that change? We don't know. But again, I was in complete shock to learn that An estimated 452,000 individuals 62 and older are in default of their federal student loans. So this is a problem that's going to have to be addressed right now. It looks like they're pausing, which is kicking the can down the road. We'll see what happens in the future, and we'll keep you apprised. For at least the last decade, if not more, reverse mortgage professionals have sought to gain increased acceptance among financial professionals, but largely our efforts have been stymied by strong resistance to their clients incurring additional debt in retirement, and of course, the myths and the misperceptions that persist. But more financial planners are actually beginning to embrace the value of a reverse mortgage as a retirement planning tool, so that's good news. And such is the case with one planner that Housing Wire's Reverse Mortgage Daily interviewed, Rachel Gustafson. So let's look at some of the highlights from this story. She is with Financial Investment Team that is based in Portland, Oregon, and she's been a certified financial planner for 12 years. And so she looks for solutions for her clientele. But when she first encountered reverse mortgages, I think that she reacted like many financial advisors do, and that's with aversion, just keep this away from my clients, right? So what shaped her opinion initially? Well, oftentimes for a certified financial planner or any financial professional, they're being mentored by someone with more experience in the field. And the traditional view amongst financial planners is just to steer clear of them. And she said, my financial mentor or advisor was very much against reverse mortgages, a common sentiment that we see, unfortunately. So mentors have an incredible influence over those that they're working with, and they do largely in part shape their viewpoint on many financial products, including reverse mortgages. But that began to change when she met a couple of reverse mortgage professionals with whom she now has a referral relationship with. So she feels like it's a good fit, then she can send these individuals over to these reverse mortgage partners with great confidence. But there is also something else that happened. How did this come about? Well, it was BNI. That is Business Networking International. If you've ever been a member, it's where you meet other professionals in a group and you provide leads to her. And in her group, she had a reverse mortgage specialist, but she still had kind of the vestiges of that viewpoint that her mentor had passed on to her, which was very anti-reverse mortgage. But what really helped her become more comfortable with the loan is learning about a lot of the changes that began as part of the Reverse Mortgage or HECM Stabilization Act of 2013. We had a wave of regulatory changes, consumer protections, and those have, of course, really, I think, helped the reputation of the reverse mortgage. I would say especially the non-borrowing spouse. And the most important thing is one of her referral partners in her BNI group shared real-life experiences from his borrowers and what his clients were using the reverse mortgage for. And she said, he introduced me to other advisors who were already using the reverse mortgage, which, of course, would further bolster the image of the reverse mortgage in her mind. But this is one of the reasons I think a lot of financial advisors don't want to get involved in reverse mortgages. She says you don't always want to be the first person to jump off a ledge, so to speak. But in speaking with other advisors who were actually using it and showing that it was successful, and then being able to help clients achieve certain goals that they wouldn't have been able to without a reverse, well, that's what really opened her mind up to the reverse mortgage. So this is on Reverse Mortgage Daily under Housing Wire, and we've included a link at HECMWorld.com that you can peruse. Last week, I came across an interesting column in MoneyWise. We've drawn from that well a few times before, but I like the, writing a letter to, it's like Dear Abby, right, for finances, but the writing into the columnist. And this woman is 59. She's single and she wants to retire, but she still has about an $81,000 balance remaining on her mortgage. Should she keep working, or does she need to pay it off using some other funds? And I think this scenario really is going to hinge on what funds would be used, right? But this particular individual who wrote into the columnist is not alone. In fact, there's an increasing number of Americans, older Americans, who are carrying mortgage debt. Back in 1989, it was just a little less than 1/4 of Americans, 68 to 79, that still had a mortgage balance. But then we've seen that change. By 2022, 41% have a mortgage balance. That according to a report from the Joint Center for Housing Studies at Harvard University. So as of 2022, just 3 years ago, the median mortgage debt carried by those 65 to 79 was $110,000. Now that's 400% more than it was in 1989, but I think that's apples and oranges because home values were quite a bit lower. So, of course, mortgage balances would have been lower at that time as well. And what's the real advantage of paying off a mortgage? Well, there are some, of course, cash flow, but then also what you've done unwittingly is tied up all that money. Let's say you pull it out of a retirement account into the bricks and mortar of a home. And older individuals may find themselves unable to qualify for a traditional or home equity line of credit loan in the future, which would really put them in a hard position. You want access to that money when you need it the most, especially if you experience a financial shock. Another advisor wisely notes the opportunity cost by sinking all that money into the home and taking it out of the market. They're not going to have the returns potentially in their home equity or appreciation that they would have had in their market. So one advisor, Jay Zigmont, tells his clients, look at paying off the mortgage as a tax-free, risk-free return on the interest saved. But not all advisors agree with that particular strategy. One says paying off the mortgage at retirement is rarely beneficial. That's according to David M. Williams, who's a director of planning services and wealth strategies group. Now, he told this to Mass Mutual back in March, adding, maintaining and managing a mortgage may actually improve retirement cash flow. And he gives this example. If you're able to claim the mortgage interest deduction, then the tax break may give you just enough relief without sacrificing your savings or your investments enough to really have an impact. Now, the last option that the columnist offers, and I have to say kudos for doing this because oftentimes it's completely ignored, is reverse mortgages. It may be right, but that option comes with a lot of pros and cons. So in this situation, they don't really lay out this strategy, but I'm going to do it here. So she's 59. Let's say she works another 3 years, and that'll get her to the age of 62, right? And then she could consider getting a home equity conversion mortgage, which would allow her to retire that mandatory mortgage payment and give her the ability to retire and not have to work until the day she dies. Now, if she's in a high-value property, perhaps it wouldn't be a HECM, maybe a jumbo would be a good fit. Now, of course, there's going to be cost, especially with the reverse mortgage, because most do not make monthly payments, so you have pure negative amortization, which is going to consume the home's equity over time. Not all of it, maybe most of it, we just don't know, but what are those expenses? How do you weigh those in comparison with enjoying your remaining years without having to work? That's really the math of it when it comes down to eliminating a mortgage payment that's mandatory in this situation.